for a closer look at that market action is Cobus Potgieter from Southern Cross Capital. Cobus, always a pleasure and a happy Tuesday to you.
Happy Tuesday, Nolthando.
With that said, it really is happiness all over the markets, not only here at home, but in Europe. I'm wondering if there are some global themes that are driving the overall performance.
Yes, so starting off from offshore, which is rosy, but perhaps not as rosy as locally. We saw over our public holiday yesterday, the S&P rally to record highs, driven by buoyancy in those tech stocks. We saw yields coming off. Essentially, the market is starting to sort of price that Goldilocks scenario, the so-called soft landing scenario, where inflation tapers off whilst the economy remains relatively robust, doesn't sink into recession, and we move into a cutting cycle towards the end of this year. So all in all, pretty positive for equities and bonds overseas. And then, of course, locally, we have our own dynamics that are pushing us, into a beta of 2 or 3 off the back of this positive momentum today.
Yes, I want to speak about that and what markets exactly are pricing in here, because, of course, the political realm is still one that I would say is rather volatile, very difficult to gauge if any growth will emerge from this coalition. But markets seem to really be optimistic.
Yes, absolutely. The last time we had anything like this was called Ramaphoria, and there's nothing that slips off the tongue quite as nicely. A colleague in the office calls it coalition commotion, which is what we're experiencing at the moment. And essentially, the market's job is to price the future. And as we discussed off air, a lot of these domestic stocks that are rallying today were beaten down simply because the growth outlook was so poor. And the only reason that they would rally from those cheap levels, we've been calling SA Inc. cheap for ages. And I mean, I must point out the mid cap is up over 5% versus the market 3.2% at the moment. And that's mostly SA Inc. names, is that we were seen as X growth. And there's all of this low-hanging fruit that we always talk about, all of this reform that could happen reasonably easily. And the fact that the government of national unity is starting to take shape. We don't even have cabinet posts yet. We know the parties are still jostling, still negotiating for those posts. So some of this, might deflate a bit depending on whether or not expectations are hit or miss, or it might rally further if the portfolios, lead to the structure of the portfolios lead to better governance and better control and better policy. So that's essentially what the market is pricing. It likes this outcome. It likes that the uncertainty around the elections have gone away. And ultimately, there's a lot of optimism, and you can just feel it. It's quite a nice feeling, to be honest.
Also interesting is to see the Rand 1810. I've heard some traders say that they could see it at 1750 if things got good. Do you think we could see it at those levels again? Is that possibly far-fetched, long gone from our reality?
No, it's not unrealistic. The fact is we've got an enormous risk premium built into the rand at the moment, and on a pure purchasing power basis, the fair price is around 16, right? So, and that's pure purchasing power, and given the risk here, they would be pretty preposterous. But another sort of 60 cents from here, that's not unrealistic at all. They would still give you significant carry, a significant risk premium, and it would be quite a reasonable outcome. But if you had taken that bet, given how fat that premium was a couple of weeks ago in long dated South African bonds, you've done phenomenally well over the last 2 weeks.
I want to get into some company news now because it's actually a little bit positive on that front too. Maybe starting off with storage. They really have knocked it out the park. I think they've described their own performance as exceptionally strong. I don't think anybody can argue with that at this point.
No, and it's such a boring model, but I mean, they've taken literally the most defensive, predictable subsegment of that REIT space and just executed on a very focused strategy incredibly well. And I mean, we've seen the attributes of that sector as just so defensive. It is enormous. The business is sticky. They're not as subject to sort of the whims of the consumer or retail or commercial. There's obviously no work from home affecting them as it is almost all of the other subsectors, with perhaps the exception being warehousing, which is quite similar to where they target. So really excellent performance, and again encouragingly, particularly from South Africa, the UK operation lagging somewhat behind South Africa, even though the outcome there was also pretty good. So I mean, knocking it out of the park relative to the strategy, but nothing ridiculous, quite predictable, one would say, in terms of the actual return, and still yielding nicely. And somehow they've eked out a growth market in a sector that's pretty much ex-growth.
I also want to speak about Telkom. This is one of my favorite comeback stories right now. Of course, we know that Telkom went through a bit of a rough patch. And I think what's interesting here is the CEO was very clear about the fact that they're expecting these impairments to move through the financials and that a better picture would present itself afterwards. And it looks like that's what we're seeing now. They've swung from quite a loss to a profit of over R1 billion.
Absolutely. And it's nice. I think with these guys, you often just sort of looking out for those terrible surprises, so just like getting rid of all the write downs in the base, that already helps plenty. And it is a nice business with excellent assets, and that's why we saw, sort of sutures circling for it when it was particularly distressed, but quite encouraging that they are anticipating to deleverage so proactively over the next 12 months that they could return to a dividend paying position in 2025. That's a very nice outcome. And given that sort of data driven, data first strategy, which they have been pursuing, which is their strength materially, the backbone of the infrastructure. One could argue the same of Eskom. That's where they should be focused, and that under the new leadership seems to be paying off. So turning around nicely, and I mean it's inexpensive still. So one has to wonder if perhaps one of the other big players won't take another swing at it at some stage. But maybe they should have tried to pay a little bit more when this thing was more distressed, and not have been shopping for a bargain as much as they were at the time.
I also want to get your thoughts on news around Sanlam acquiring 60% of MultiChoice's insurance business there. I think it's just over R1 billion being spent there. Of course, we know why Sanlam would go in this direction, but MultiChoice, also interesting to find out that they would use the proceeds for working capital purposes. It sounds like a capital mismatch to me.
Yes, yes. We chatted about this briefly off air, and we've seen that kind of thing before. We had clicks operating on an ROE of 45%. So one could argue cash is yielding 8-9%. So I should be reinvesting that into working capital, where I'm making 45%. But I mean, this is quite a special situation, to be honest. We've seen a lot of businesses venture off into these little side hustles where they have a distribution. Vodacom does it. They also sell insurance, and for MultiChoice, it did make a bit of sense, but they don't have the critical mass. This business is worth a lot more inside of Sanlam than it is inside of MultiChoice, and I think what you'll find in their defense is, yes, it sounds boring to invest into working capital, but the capital requirements for that little insurance business is probably makes it a poor return on equity, and on that basis, investing into your own working capital makes a little bit more sense. That being said, the performance of those other assets has not been phenomenal, so they are investing for the future. And one could take a bit more of a cynical view and say they are busy cleaning up the balance sheet for their potential suitor in Canal Plus, who is in all likelihood not interested in a decoder insurance business. In any case, we know they are much more digitally focused. So there's something to this, and ultimately they don't need to have that money earmarked. Essentially, it's just a message to the investors that we won't be paying a dividend. We see more value reinvesting this into the existing business. But I agree with you; these sorts of things need to be scrutinized, and management tunnel vision needs to be considered as well.
Well, that's it, Cobus. I'm keen to get your stock pick, but first let's reflect on counters that have found favor with your industry peers.
Today, I'm looking at Bidcorp yet again. I know you and I have chatted about this before. I think right now everyone's focused on domestic stocks and everyone's focused on what could happen domestically. But I think some of these rand hedges have been sold off quite significantly. Bidcorp today is trading around 400, which is a multiple below what we've seen them trade in a long time. It's about 15 times. This is a solid business with a solid balance sheet that caters for out-of-home eating in developed markets. They've got a solid margin. Their top line is not at risk when we saw their recent trading update, and I think they still have a bit of momentum over the next couple of years. So that's going to be my pick today.
So my stock pick is BYD, which is basically an electric vehicle company. Just looking at their company in this past quarter, they've actually outsold Tesla. And looking at from a manufacturing point of view, is that they are subsidized by the Chinese government. So they are out there making really, really affordable electric vehicles in comparison to your likes of Tesla and so on and so forth. I've even found it interesting that in the US and in Europe, they've actually imposed tariffs on BYD in order for their electric vehicle sales to be a little bit more competitive. Regardless of those tariffs, the share price seems to still be rising, so it is an interesting stock to look out for.
All right, Cobus, keen to get your thoughts on those, Bidcorp and BYD.
I like both of them, but let's say not in equal measure. Obviously, I'm much more familiar with Bitcorp. I agree the current entry point is reasonably attractive compared to historically. Obviously, it's rand hedge, so not thriving in this environment over the past week, but perhaps that's precisely the reason. We're probably seeing a lot of people selling offshore holdings to buy South Africa at the moment, and given the rand strength. It creates a bit of an opportunity. Really nice business, very defensive, obviously very, very UK, Australia focused, and a very decent set of results, in fact, recently. So I still like it a lot. And at this level, it's quite an attractive entry point into a quality ticket, which has done pretty well for its holders historically since being unbundled out of Bidvest. BYD, build your dreams. The world's number one EV maker. Also, really, really interesting business. Perhaps a bit more risky. It's on about a 17 forward. It's at an all-time trading at an all-time high. Fully integrated. They even make their own batteries. They are not dependent on essentially any external provider of components. And I think it's interesting that your analyst noted that they are subsidized by the Chinese government when BYD still actively deny that this is the case, even though that's, call it the reason that the Europeans and the Americans are imposing tariffs on them. So there is a bit of a proxy trade war going on when BYD is right at the center of it. But given their positioning, I think it's probably not that expensive, probably something reasonably good quality to also take a bit of a flutter in your portfolio, in your international portfolio.
And which counter are you going with this afternoon, Cobus?
I'm going to go boring with a local bank, ABSA, the cheapest of the lot. It's doing incredibly well today. It's still trading at around 1 times book value. It doesn't do well, in terms of the call it that expansion between the borrowing and the lending rate, as much as a net bank or a standard bank. But when we do hit the cutting cycle, they'll be better hedged in terms of protecting that spread. And of course, just the general outlook for South African banks and SA Inc. Seems to be a bit more rosy, a bit more growth, perhaps a bit less pressure on the consumer as we head into that cutting cycle as well. So altogether, the cheapest of the bunch, the yield is higher than the PE, and reasonably well positioned to exploit any bullishness and ideally better policy, better growth, better outcome for the South African economy in general.
Wonderful, Cobus. It's always a pleasure having you. Thank you so much for getting the week going for us, actually. And that was your midday markets update with Southern Cross Capital's Cobus Potgieter.